We're actually very pleased to say that 2024 was actually our best year. We delivered the highest return that Mansa-X has actually been able to give its investors since its inception about 6 years ago. The return for the Kenya Shilling Fund was 19.53% net of fees, and the Dollar Fund returned 12.5% net of fees. I mean, if you compare this to our average over the last 6 years, the average for the Shilling Fund was about 18%, and slightly under 18%. So a 19.53% return is actually much higher than what we've given our investors on average. If you compare last year's return to 2023, the Kenya Shilling Fund in 2023 returned about 18%. 18%. So again, that's a 1.5% better performance in 2024. And the Dollar Fund in 2023 returned about 12.1%. So again, a 40 basis points better return in 2024, even for the Dollar Fund. So we are very excited about that return, and we hope our investors are very pleased about that. If we look at that performance, again, it's very interesting to see that performance, even compared to the assets under management, again, that's even more, it becomes even more impressive. Because in 2023 we were managing about 22 billion assets under management for investors, and in 2024 we closed the year with about 46 billion assets under management. So that's about 110% increase in AUM without compromising the return for investors, and actually even better in the return. So that's why we are very pleased with the 2024 result. And even the number of clients that we are serving in the fund, again, doubled, essentially. We had about 11,000 clients in 2023, and we closed 2024 with about 22,000 clients. Again, showing the confidence in the fund, and something, again, we are happy and very thankful about. We started 2024 on a very high note, considering that the S&P 500 was up about 25% in 2023. So of course, there was a bit of caution as to whether there will be a continuation of the bullish trend. And the main thing that we were actually looking at in 2024 was the action of the Fed. And this is compared to what the inflationary numbers were. So going into 2024, most investor expectations were that the Fed would have 7 rate cuts. We were expecting 7 rate cuts in 2024, and the main thing that happened therefore in 2024 was that we actually ended up with a much less number of rate cuts, just 3 of them. One big one of 50 basis points, followed by 2 smaller ones of 25 and 25. So 100 basis points rate cut in 2024 is what we got, but market still remained bullish. Our tech stocks, our usual Magnificent 7 tech stocks, continued to hold the S&P's performance. In fact, you can say the S&P performance in 2024, which was about 23%, was a big contribution. About 60% of this was actually can be attributed to our Magnificent 7 tech stocks. So 2024 was really an interest rate observation game, and again, we also had elections and the impact of those elections on Fed activity. So with the presidency of Donald Trump coming in the later part of the year, one of the things we noticed is markets also turned very bullish because they actually viewed Donald Trump as the one who's most likely to insist on a bullish stock market. So the sentiment was again positive for stocks. The only thing we saw that this impacted the Fed with was expectations of changes in inflation due to changes in tariff policy, because there's expectations, and there remains to be expectations, that the new administration might impose higher tariffs on other markets, especially China, and this is likely to have an impact on inflation. So we saw again a slowdown in the dovish stance by the Fed, leading to a slightly hawkish stance by the Fed towards the end of the year. So that's really what we saw in the U.S. markets. Commodities were also very interesting in 2024. One of the commodities that really outperformed was cocoa. Cocoa actually jumped 170% last year. This is really because of concerns around the weather in West Africa. So we actually saw a decline in production of cocoa in the global markets, and then a higher demand. So you had a higher demand on cocoa and then less production. So that led to a significant jump in cocoa prices. Another one, and this is actually one of the assets we were also holding, was natural gas. We saw a huge surge in the price of natural gas by as much as 60% year on year, again because of higher demand. Heating requirements towards the end of the year actually led to higher natural gas prices. We saw again a shift a little bit of a shift in the policy for the Japanese yen. So a slight increase in the interest rates for the Japanese yen, so what you call an unwinding of a carry trade, meaning that a lot of people who are short the Japanese yen actually exited that position. So for a very brief moment there in August, we saw the Japanese yen increase in value slightly, but this is important because there's something called the carry trade, where typically investors who invest in dollar assets will borrow will borrow Japanese yen, convert that to dollars, and then invest in dollar-denominated assets. However, if the Japanese central bank increases interest rates, then it means that it becomes more expensive to borrow Japanese yen to invest in dollars. So that's something that investors watch for very closely globally. So for a brief moment in August, a slight uptick in the cost of the Japanese yen caused investors to actually exit what you call the carry trade. But towards the end of 2024, this normalized, and we've seen the Japanese yen go back to its weakness that is expected against the dollar. Locally, the most interesting stock we were watching and was one of our top holdings in 2024 was Bamburi stock. At its height, Bamburi stock was actually up about 133%. And this was really because of the takeover from Amson. So we had a company called Amson from Tanzania that was looking to and actually took over Bamburi from the local investors, and this caused the stock to actually go as high as 133% in terms of its performance year on year. So that was a very interesting thing to watch. The NSE itself did pretty well, returning over 30% year on year to investors. From a monetary policy action, we saw the CBK again continue to cut interest rates in line with what every other central bank was doing globally. So the CBK cut rates from 13% CBR to 11.25%. We expect that this easing of interest rates will continue locally. The shilling, I think, was the biggest winner locally last year, 2024. The shilling gained 17%, which is quite significant for a yearly movement, gaining from 155 against the dollar to close at about 128.5, 129.5 against the dollar by the year end. We expect that near term, the shilling will continue to be supported by various fundamentals, the key one being very sufficient forex reserves that have been held by the central bank. One of the things that our investors and potential investors always ask us is, how are you able to generate the returns that you do? Because they seem to be above average. So some investors therefore wonder, are we taking on more risk in our books? Is it a potentially much more volatile fund? Or what's the deal with Mansa-X? How are you able to generate this? I just want to emphasize that we give the returns that we give because we have a much more diversified approach to our investing. We invest in markets that are much bigger than the Kenyan market. We invest in the US market, we invest in the UK market, continental Europe, Asia. So we have a lot more asset classes that can then generate the return that we give. That is why Mansa-X is able to give this return. Another thing is the fact that we have the capacity to go short when markets are not doing very well, meaning we can actually take advantage of asset classes that are losing value using what you call a short trading strategy. So being in a lot more asset classes and being able to go short when markets are not doing well not only gives you an above average market return, but also tends to smoothen your returns over time. But then if you actually look at some of the companies that we invest in and you look at how they have performed over the last 30 years, it's quite fascinating. Take a company like NVIDIA. A company like NVIDIA for the last 30 years has actually had an annualized return of about 37%, meaning that a $10,000 investment in NVIDIA 30 years ago would now be worth almost $37 million. You know, if you think about that, it's quite fascinating. I mean, it's mind-boggling. Even if you look at Amazon, if you had invested $10,000 in Amazon at the IPO 30 years ago, that investment would be worth about $29 million now. And the list goes on and on. Monster, which for the longest time was actually the highest performing company on the S&P 500, has had an average return annualized of about 31% year on year for 30 years. Again, a $10,000 investment would be worth about $27 million now. More recently, companies like Tesla has had an average return of about 46% annualized year on year. Again, if you had invested in Tesla, a $10,000 investment would be worth $2.5 million now. So I give you these numbers just to demonstrate that the market, the potential for outsized returns is much bigger if you look at investments globally, which is what Mansa-X does. And that is why over time, Mansa-X is able to give a better return. And in fact, we use a lot of tools to sort of reduce the risk for investors. So the return that we are giving you is what you call an alpha return, meaning that the risk that the fund is exposed to is not exactly proportional to the return you're getting. We actually give you a return that's actually disproportionate to the risk that as portfolio managers we actually expose the fund to. So for investors that we have and investors that are looking to join us, it's very important that you note that what Mansa-X creates for investors is quite unique locally, but globally this is something that has been done and continues to be done on various funds globally, whether it's in Wall Street or the City of London and so on. And this is something that we expect moving forward we will continue to help our investors gain exposure to, so that over time you'll always have returns that should on average be better than what other funds are giving you locally. So now we can go through the top 10 holdings of the fund, and I'll just go through the top 10 holdings for both the Kenya Shilling Fund and the Dollar Fund. And it's important to note that this is actually information that we give our investors, both the existing and potential investors, in our Mansa-X Special Fund fact sheet. And again, please note that the top 10 holdings tend to change from time to time. They're not static. They are essentially just based on what we view to be opportunities in the market at that particular point in time. And they tend to vary from quarter to quarter, but largely the strategy remains the same. So for our investors and potential investors, please go through the fact sheet. It has a lot more details, and your financial advisors should have shared this with you. And if not, you can also reach out to us, and we can also share the fact sheets with you. The other document that is also very important for investors to read is our global market performance and outlook document. That's a much bigger document than the fact sheet, and again, it deep dives into what I'm talking about in this video and helps you to get an idea of what informs our investment making process and what you should be looking out for in the coming financial period. So on to the top 10 holdings for the Kenya Shilling Fund. The top two holdings were actually interest rate products. The fixed income instruments refers to essentially bonds. And in the case of our funds, were really mostly exposure to African Eurobonds, which, especially if you look at the Kenyan ones, actually had a very good year, with an ROI based on buying and selling of those papers, not less than 30% ROI for investors there. Interest rate derivatives, this is really just exposure to near, medium, and 10-year interest rate, bonds for the US bonds, the UK, and also German bonds. Again, this is a very actively traded book, but helps to create exposure to interest rates, which is a very active market that we trade in Mansa-X. Then the other, the number 3 top holding was S&P 500. As I mentioned earlier, this was up about 23% last year, so we benefited from that. We were also a natural gas with a long position in that. Natural gas was actually up 60% last year. The Canadian dollar is actually a short position, and like I mentioned earlier, sometimes we are in short positions. So we were actually short the Canadian dollar, and it actually lost 9% in 2024. Microsoft gained 12% last year. Again, we were along that position. Palantir Technologies, these are stocks that we are really watching because of their significant role that they play in AI, and we believe that moving forward, this will really be one of the, for investors, companies that are really into AI and are important in the growth of AI as a product, are companies that you should be investing in, and we are also investing in them. And Palantir actually gained 340% in 2024. Netflix, again, a company that did very well last year, gained about 83%. Eli Lilly and Company, Eli Lilly is a pharmaceutical company, was up 32%. Geographical distribution for those top 10 holdings was mostly in Americas. About 50% of the Mansa-X book gives you exposure to American markets. The rest, about a third of them, is in Europe, and then Africa is about 13%. Then Middle East, Asia, and the Oceania region, slightly under 5% of our book. So for the dollar fund, again, the holdings are very similar. We had the fixed income and interest rate derivatives products. We had Nasdaq. Nasdaq was up 24% last year. Canadian dollar, similar to the Shilling Fund, down 9%. Natural gas. We have a few companies that are different, like the Taiwan Semiconductor Company. This was up 89%. These are chip makers, just like NVIDIA. And of course, as we go into a world where a lot more data processing is required, as AI takes hold, as I mentioned earlier, then chip making companies become very lucrative to invest in. This company was up 89%. Broadcom, up 107%, again, the same sector. Gilead Sciences, a pharmaceutical company, was up 14% last year. Then finally, we had also invested in Morgan Stanley in the dollar fund, yielding about 34%. Some investors have asked why the list is not exactly the same. This is really because of what you call entry points. As you create portfolios, different entry points create different opportunities, meaning that if a stock was, maybe when we are entering Microsoft this week, it might not necessarily be a lucrative time to enter it if we enter it next week. So as you deal with different portfolios, your top holdings might differ from time to time. That's why they can't be exactly the same. Geographical distribution for the dollar fund, very similar to the Kenya shilling, about 54% in American markets, 30% in Europe, 13% in Africa, then the rest in Middle East, Asia, and Oceania regions. Like I mentioned, you can find this detail. You can find all this detailed in your fact sheet and the research paper that we distribute to our investors. It's actually been a very good 2 years for stock markets, especially the US market, where, as I mentioned, about half of our investments in Mansa are actually placed. So, of course, one of the concerns for most investors is, does the rally continue? I mean, we've had S&P performing over 20% year on year for the last 2 years. So maybe just to look at it historically, typically bullish markets, especially a bullish trend in the S&P, tends to last a minimum of 5 years. Okay, so being into the third year of a bull market is not a bad sign. We still think that the S&P 500 will continue to perform well into this year. There are a number of reasons why. One of the reasons is actually just the earnings growth for companies. In 2023, we saw companies' earnings grow by about 5%. Then in 2024, we saw that double to about 9.5% to 10%. So that's a very good thing. And we expect in 2025 that earnings will grow by about 15%. So that keeps us very bullish on the stock market as well. The other thing is that the US market is still expected to grow. Last year it grew by about 2%. We expect almost 3% growth this year. So again, this is keeping us very optimistic on the stock market. So one of the things that a lot of investors have concerns about is, with the Trump administration, what are the fears around tariffs? One of the things we have seen is that, yes, the Trump administration has made it very clear that they will increase tariffs. Currently, the average tariff is about 2%, and this is expected, according to campaign talk, to increase to about 17%. But what we also know is that we have actually traded markets before during a Trump administration, and one of the things we noticed was he tends to align economic success with stock market performance. So we still expect that if the administration sees that the effects of tariffs is anything negative on markets, they are expected to then maybe likely to pivot that, because we've seen them prioritize a better performing stock market to anything else. Again, that gives us more confidence when a Trump administration is in power in terms of how the stock market behaves. The other thing that we expect in 2025 is we are likely to see a broadening of the companies that contribute to the performance of the S&P. For the last 2 years, we've mostly been focused on tech companies, especially the ones that Magnificent Seven, because of their exposure to AI or their contribution to the growth of AI. Now, the efficiencies that we expect to then flow to other companies will lead to a broadening of the performance of the S&P. So we expect to see a lot more utility companies, financial companies, and consumer discretionary companies in 2025. So you have an S&P that we expect to continue to do well, but the contribution this time might come from unexpected quarters, but most likely in those sectors of financials, utilities, and consumer discretionary. The other thing is, again, with a new administration, one of the things we noticed during the last Trump presidency was actually deregulation. Okay, so deregulation tends to really help the oil and gas industry. So we expect to see better performance there, and also the financial industry. That's something we'll also be watching. 2025 is also a keen market to watch in terms of geopolitical tensions and how the new administration will actually deal with this. One of the things we expect is some sort of negotiation or ceasefire, if actually to the extreme, with Hamas. That's one thing we'll be looking at in the Middle East. The other thing we'll be looking at is probably some sort of deal between Ukraine and Russia, because again, that's something that the Trump administration has been very clear about needing to have a deal on. Locally, we expect that global opportunity cost for fund managers globally will reduce, making it easier for them to invest in frontier markets like ours. So we actually expect that the NSE will continue to be elevated. We already saw this happening towards the end of last year. We expect a continuation of this in the new year. Again, mostly because of foreign investor coming back to the market. From a monetary perspective, locally, we expect that the CBK will continue to reduce interest rates. The inflationary numbers are essentially very close to the bottom of the band, because the band for CBK for inflation is between 2.5 to 7.5, and now we are hovering about 3%. So there's a very big potential for them to continue cutting interest rates because of inflation being low, as I've mentioned, but also we are at essentially zero growth. I mean, we are at a 0% growth in credit, and that's not good for the country. So we actually expect that the CBK will continue cutting rates, in essence, just try to jumpstart the Kenyan economy. So we expect to go to be sub 10% in terms of the CBK rate. Now, this will drag down most of the yields. We expect that, especially for near-term money market instruments like T-bills, we expect that yields will continue to come off. But essentially, it will be a year where we expect rate cuts, not as aggressively as had been envisioned before, but rate cuts nonetheless. And even just going back again to the US market, one of the things we've always noticed is that the stock markets typically tend to do well in an environment where there is rate cutting, no matter any other circumstances. So the fact that we still expect at least 2 rate cuts for 2025 from the Fed should also again keep stock markets elevated. So we'll be watching those, as well as the impact on yields, and see whether we can also take advantage of any volatility in yields that will happen, and therefore take advantage of actually active trading in fixed income instruments. Finally, I would like to take this opportunity to thank our investors. Our investors are really the reason we are here, because we started this fund about 6 years ago, a very unique proposition in the local capital markets dynamic. And of course, it would not have been able to grow to this level without our clients actually believing in us. So we are really thankful for that. I mean, we've grown the fund to manage now almost reaching 50 billion shillings assets under management. And this is really just because of the support we receive from our clients. The fund has been in existence now for 6 years. We are now, this will be our 7th year in existence. And time flies, and this whole time, our investors have been really supportive. So we are very thankful and quite honored that you can give us that opportunity to serve you. So even when you look at it from an SIB perspective, SIB is actually turning 30 years this year. So we'll be looking forward to celebrate this with our investors, and it's something that we're also very excited about. It gives us a lot of thankfulness in our hearts, but also makes us feel the responsibility even more to continue managing this fund in the best way possible, continuously watching the portfolio that you have entrusted us with, so that we watch the downside risks all the time as we continue again to try and give you alpha returns, returns that exceed what is out there in the market. So that continues to be our everyday responsibility and promise to our investors that we will do the most we can to take care of their funds. So as we enter our 7th year of Mansa-X, our strategy and outlook remains the same, trying to be as well diversified as possible, be in markets that continue to make sense for our investors, avoid excessively volatile asset classes, and over the long term, we believe that our investors will continue to grow their capital without any excessive downside risks to their portfolios. So wishing you all a happy new year for 2025, and looking forward to more engagements. One of the things that are different this year, and again, this is because of the support we receive from our investors, we are now categorized as a special collective investment scheme. And in fact, to that effect, we are really the 3rd largest in the country. And this is as at September last year. So we will now, one of the things that will change is that now we'll be, from a regulatory perspective, now we'll be holding AGMs. And our first AGM will be in April of this year. So we'll be looking forward to engage with our investors, our stakeholders like the trustees that we have, our custodians, and we'll be looking forward to engage with our clients. We can have a conversation around how the fund is run, what more expectations you have from us, and any other even propositions for certain things about the fund that you'd want to see done differently, and so on. So April this year will be our first AGM, but we believe that even before then, we'll still have more continuous engagements with our investors. We had a webinar last year, towards the end of 2024. We noticed that it's very popular with investors. We'll continue having those Q&A sessions with you, again, to continuously help our investors, both existing and potential, to fully understand the fund. And hopefully we continue growing this fund to a much bigger fund and better performing fund. Thank you.